Amazing. Well, good morning, everyone, and thanks for joining in this beautiful sunny weather. Obviously, appreciate everyone's time here. So my name is Apoorv, and I'm the co-founder and CEO of Roam. So Roam is it's a vehicle subscription company, right? We've heard about vehicle subscriptions for a very long time, and I can say this is my second time at it, and I'll tell you a bit more about it. But we started 5 years back, and we essentially offer vehicles to consumers and businesses that are looking for shorter term commitments, right? So that sweet spot between a daily rental and a long-term lease. And we pair that up with auto insurance, roadside assistance, and mobile preventive maintenance, meaning all the maintenance is actually done at the place of business or at the consumer's house. We're backed by some of the largest venture capitalists and family offices in North America. And prior to Roam, as I said, this is my second time. I ran one of the largest vehicle subscription companies in Latin America and Brazil. And we were primarily providing vehicles to a lot of the gig economy companies there. But at scale, we had thousands of vehicles spread out across 5 cities. And the company was bought out prior to COVID. Now, I can tell you a lot of stories from Brazil about fraud and how, my first 2 months in Brazil, I had to repo cars in Rio de Janeiro in the favelas. But I'm going to leave that for another time. So today I'm going to be talking about the future of commercial leasing and fleet management. And specifically, a lot of the points that I'm talking about, these are actual testing that we are doing with Roam's own, we call it Fleet IQ. It's an internal fleet management software that we use for our customers, but also for our own fleet. So the concept that I'll be talking about today is going from fixed contracts to intelligent contracts. So you have 2 pickup trucks here, right? They're the exact same year, make, model, and trim. And for all intents and purposes, for leasing, it's the exact cap cost, interest rate, residual rate, and monthly payment, right? So they're financed the same, they're insured exactly the same, and they're regulated exactly the same. But truck A is driven predictably. It's always has its maintenance done on time. It's rarely ever idling, and it's driven within its design limits. Truck B, on the other hand, it's constantly overloaded. It's never maintained on time, and idling all the time, and being stretched past what this truck was designed for. Now, we all know which of these vehicles we would like on our balance sheet today, but up until now, a lot of the vehicles that were on the road, they didn't really allow us to get this information in time. So what usually happens is these vehicles get leased out, and at the end of the lease term is when we all get a surprise, right? Either the vehicle it performed exactly according to the lease contract that we signed, or it actually veers off track and the customer ends up owing thousands of dollars. But this concept doesn't have to continue going the way it is, right? With the new generation of vehicles, there are thousands of data points that are being transmitted on a daily basis, and they tell us about the condition of the vehicle, the usage patterns, and the behaviors. And for the first time, we can actually go from assumptions to actually how the vehicle is performing. So when capital risk and regulation, when they start acting on real data and not historical averages, that's when the unit economics of commercial leasing will fundamentally change. So when you're looking at the industry, there's multiple irreversible trends that are happening, but I'm going to talk about the top 3 that I'm sure the first one is on everyone's minds here. So the first one is electrification and autonomous vehicles, right? So whether it's fully electric, plug-in hybrid, or hybrid, any sort of electrification that's happening with the vehicles, and then autonomous vehicles that are now slowly emerging on the roads. Now, obviously, these vehicles are, there's a heavy upfront cost, and a lot of times they're also very expensive to repair. But when it comes to predictable maintenance, like preventive maintenance, these are the cheapest vehicles to maintain on the road, and they also have a longer lifespan. And again, this is not, it's not standard across the board, but for most major EVs, this holds true. One conversation, I believe there's another panel happening, is there's obviously a challenge with the residual values, because a lot of these vehicles still have not had enough time in the market to have historical valuations. And in some cases, there were external market factors that really impacted the resale value of these vehicles. The second trend is software-defined vehicles. So for the first time in our generation, we have vehicles that are constantly communicating with us. Again, there are thousands of data points being generated on a daily basis. And these are essentially software on wheels. And the third one is increased regulatory compliance. So with more and more electric vehicles and autonomous vehicles entering the fleet, and with more data being exchanged on a daily basis, compliance is no longer periodic, it's going to be continuous. So when you think about leasing, again, in its current state, it's built for static assets, or it was built for static assets. So when you put a lease agreement together, you're looking at historical averages. You're looking at the resale value of a car, the fixed monthly amortization rates that we get from the banks, right? And that agreement is put together for a period of time, and it's never, ever really revisited until the vehicle comes back. Right? So even though there's supposed to be some sort of inspections happening on the vehicles, we all know majority of the times these vehicles are inspected once they're back from leasing. But it doesn't have to be like that moving forward, right? Every vehicle, so just to give you an idea, a single vehicle on the road has 100 to 200 sensors, right? 200 being on the higher side for autonomous vehicles, but they're generating 600 gigs to 4 terabytes of data on a daily basis. This is one single vehicle. And to put it into context, this is equivalent to an average Canadian using their email, WhatsApp, messages, apps on their phone for the next 15 years. That's how much data one car is producing. And for all the coffee lovers, if data were to be coffee, this is equivalent to an Olympic-sized swimming pool being filled every single day. So just the sheer amount of data that we're generating from these vehicles now allows us to get this information very early on instead of waiting until the end of the lease. And that's where what we're talking about is we've been financing assets that are now dynamic. They're living, they're intelligent, they have all the data that we're able to collect, but we've been managing them statically on paper. So the concept that I'm talking about is moving from fixed contracts to intelligent contracts, right? To living risk models. So if you look at that image on the right, it looks very futuristic, but essentially what you're seeing is the monthly payments evolving based on, number one, the change in residual value, and two, change in the market value of the vehicle, right? So now the change in residual value is heavily based on usage and behavioral elements. So when we're talking about usage and behavior-based underwriting, we're talking about things like, is this vehicle being driven aggressively on the road, right? Is it taking harsh turns? Is it harsh accelerating? Which means that by the end of the lease term, more than likely, it's going to require a change in brake pads, a change in tires, something we don't foresee until the vehicle actually comes back. And things like, was this vehicle maintained on time, right? So if the vehicle is getting all its oil changes on time, it's still within the manufacturer's warranty, right? And did the vehicle get into any accidents? If you think about it, majority of the vehicles, once they get into an accident, we don't really see the impact until, again, they're back from the lease contract ends and they're back with the leasing company. So when we're talking about this usage and behavior-based underwriting, what we're saying is if we can take all of these data points into consideration, and along with the changing residual value, we can also look at the market value, right? We know that vehicles change, they evolve in the market. We've seen this with EVs where back in 21 and 22 with supply shortages, and in some cases, vehicles were being sold for more than brand new, the same vehicles that were being sold brand new. So taking into account the changing residual and the change in the market values, the living risk model basically changes the monthly payment every single time data is exchanged. And I know this sounds outlandish and maybe it sounds futuristic, but this is exactly where we're headed when we're even looking at autonomous vehicles. And then what this allows us to do is it allows us to adjust early. It allows us to have early intervention. So when a vehicle is coming back, instead of having to give the bad news to your customer and tell them they owe you thousands of dollars because the vehicle did not follow the same metrics that we put in the lease agreement, you now adjust it on a monthly basis. So when it comes back, it is exactly as per the lease contract that the customer signed. So capital, what this allows to happen in the market is that it creates predictability, it creates transparency, and capital gets cheaper when outcomes are more predictable, right? So the leases of the future are not going to be fixed contracts. They're actually going to self-correct. Now, from an insurer's perspective, I'm sure there's a few insurance companies in the room. We've been talking about UBI for the last few years, right? Usage-based insurance, and this concept of driver risk scoring. The data points that we're personally now collecting in our fleets, aside from harsh acceleration, harsh braking, the basic data that everyone's seen over the past few years. We're now able to see if a car is tailgating, if a car is repeatedly violating blind spot sensors, right? There's so much data that's coming back, and this risk score is now actually getting more and more accurate in predicting accidents and whether an accident's going to happen or not. And this stat that I have at the bottom, it's actually from Samsara and Geotab, and basically what it's talking about is that a mix of telematics and correctional behavior. So it's not just detecting whether a vehicle is being driven aggressively, but it's actually also taking some sort of corrective action. It actually reduces the crash rates in the fleet by 68%. And that's a significant amount when you're talking about hundreds of vehicles across the fleet. And the same thing applies for preventive maintenance, right? These cars are screaming. They're telling us if something is wrong ahead of time. We don't have to wait until the last minute when they break down and there's costly repairs that no one expected. And the worst part is downtime, that companies that are using these assets to generate revenue, that is the last thing that they want to be dealing with, right? So having this data for preventive maintenance that lets you know when vehicles are going to require some sort of intervention actually reduces your last minute repairs by 20%. And we're talking about downtime reduction by 30%. Again, I'm going to stress the fact that for a business that may have hundreds or 1,000 plus vehicles in their fleet, this can translate to a lot of money. And when we're looking at this concept of living contracts from a lender's lens or from an insurer's lens, at the end of the day, this benefits everyone that's involved, right? Whether it's a lender, whether it's a lessor, the lessee, or the insurance company, having access to this information and sharing it across the board actually helps prevent losses that we don't foresee. So for the first time, we actually have enough data to move from being reactive to being proactive. And finally, compliance. I know no one likes audits. No one likes to sit through those Excel sheets and trying to figure out if the fleet's on the right side of the covenants and, if we're going to have negative equity or where we're going to end up after a few years of vehicles on the road. But again, with this data that's being collected, you can have automated fleet reporting happening every single day. And this is something I can tell you we are already doing at Rome. The dashboard that we personally built, we have a pretty good idea on a monthly basis where our vehicles are sitting against the market. And what this allows us to do and what this will allow everyone else to do is that you can have compliance in real time, right? Again, it's not periodic. It's not those quarterly or annual audits that you need to get involved in. It's constant sharing of information that builds transparency and it builds trust, right? And when compliance is built into systems, the trust will automatically scale. So the next decade is going to favor lessors, number one, that underwrite behavior, not just the assets, right? So all the parts of, whether it's usage-based behavior, driving-based behavior, we have enough data to now see how the asset is performing on a month-to-month. So it's going to favor those who underwrite behavior, not just the asset on a static piece of paper. The second is those that price risk continuously, right? So again, it's not about having those yearly audits, sitting down and seeing how the fleet is doing. It's being constantly having finger on the pulse and constantly seeing how the entire portfolio is performing on a monthly basis. And the last one is building platforms and not solutions. And what that means is lenders, insurers, leasing companies, and customers, we are all sitting on data that's siloed off. And imagine if that data could be shared across organizations, because end of the day, that data is going to benefit every single party that's involved in this transaction. So this concept, this is not a technology race. It's an operating shift in the model. So the question is not if, it's who's going to lead this. And again, in the next decade, trust will be the most important asset on the balance sheet. So I'm just going to close this off with a final slide. So going back to truck A and B, again, same year, make, trim, and model, exact same lease agreement, right? Before we were financing the truck the same, insuring it the same, and regulating it the same. But what if in the next 5 years we don't have to do that? What if you can see risk from far away? You know you can prevent any accidents from happening. You can have predictive maintenance so that these vehicles are not breaking down. And compliance becomes transparent. Capital becomes very precise because now lenders are more comfortable actually lending to organizations that have data flowing consistently. And insurance becomes preventative. And what that means is it moves away from this transaction price model to a shared risk model that I was talking about earlier. So it's not whether this happens or not, it's whether we continue to use fleet as averages, and sooner or later we're going to have to start managing them as the living systems that they've already become. Thank you, guys.